What actually happens to your bank account the moment you die? Most people assume the answer is simple. The will decides, and the money moves to whoever it's supposed to go to. That assumption is wrong far more often than people expect, and it's the exact reason so many families end up locked out of money that already legally belongs to them. Here's why. A will and a bank account follow two completely different rulebooks. A will tells a court what you wanted. It says nothing to the bank sitting on your money. When those two systems don't line up, the result is a frozen account, a family standing at a counter days after a funeral, and one sentence nobody expects to hear. We can't release these funds. In most cases, that entire situation is preventable, and the fix is a form the bank hands out for free, one that almost nobody is ever told to fill out. If you want plain English breakdowns of the money rules and legal traps that hit seniors and their families when they least expect it, subscribe now. This channel exists so you're never the one standing at that counter hearing those four words. So where exactly does it go wrong? Almost always at the same point. If an account is in one person's name only, and there's no beneficiary attached directly to that account, the bank has no legal path to simply release the funds to a family member, no matter how well everyone knew what the deceased wanted. Knowing where the money should go and being legally allowed to hand it over are two different things, and the second one is the only one that matters at the counter. So what happens instead? The account gets folded into the estate process. And an estate process is not a same-day transaction. It's paperwork, court filings, sometimes months of waiting, all while real bills keep arriving on a completely different schedule. Funeral homes don't wait for probate. Mortgage lenders don't pause payments out of sympathy. Utility companies don't care that the money is technically there. So families do what stressed families always do. They put the funeral on a credit card. They borrow from a sibling. They drain their own savings to cover a bill that should have been paid from an account that already had the money sitting in it. None of this happens because a family made a mistake. It happens because nobody ever told them the bank needed a separate instruction on file, completely apart from the will. That instruction has a name. It's called a payable-on-death designation, or POD for short. And on retirement accounts, it's usually just called a named beneficiary. Once that field is filled in, everything changes. The account no longer has to pass through the estate at all. It transfers directly to the person named on the form, often within days, sometimes faster. Same bank, same balance, same family. A completely different outcome. And the only thing standing between those two outcomes is one piece of paper that most banks will hand you for free the moment you ask. Now here's why almost nobody has this handled. People open these accounts decades before they're thinking about mortality at all. 25 years old, first job, first savings account, and nobody at the counter says, by the way, who should this go to if you die tonight? The years pass, the balance grows, life happens, and the question never comes up again because the bank has no obligation to bring it up, and silence gets mistaken for safety. If nobody warns you there's a problem, you assume there isn't one. That silence is exactly what turns into a crisis, at the worst possible moment for the people you were trying to protect. Now, some people think they've already solved this by adding an adult child as a joint owner on the account, just to keep things simple. It feels like a shortcut. It is not always a safe one. The moment someone becomes a joint owner, that account stops being fully yours in the way you assumed it still was. Legally, they now own it too, right now, not after you're gone. It can be exposed to that other person's debts, their divorce, a lawsuit against them, a creditor coming after them for something that has nothing to do with you, while you are still alive and still need that money sitting there, untouched, waiting for a medical bill or a home repair you didn't see coming. What most seniors actually want isn't to hand over ownership today. It's to keep full control while they're living, and have the money move cleanly and quickly the moment it's needed by someone else. That's precisely the gap a beneficiary designation is built to close, without giving anyone else a claim on your account while you're still using it. There's a second trap that's arguably worse than having no beneficiary at all, and it's this: having an outdated one, a deceased spouse still listed, an ex-partner from a marriage that ended decades ago, a sibling who passed away years before the account holder did. That name doesn't disappear from the file on its own, and it can override every conversation you've had at the dinner table about what you actually want. An old form sitting quietly in a filing system can carry more legal weight than 10 years of family discussions. And if you haven't checked that field recently, you may be trusting a decision made by a much younger version of yourself. This is more common than most people think. A will almost always gets updated after a divorce or remarriage because a lawyer walks the person through it step by step. The beneficiary form sitting at the bank, 3 branches away from anyone's memory, often doesn't get touched at all. It happens constantly with retirement accounts especially, where a form filled out at someone's first job in their 20s is still sitting on file 40 years later, completely unchanged, naming a person who may not even be alive anymore. Nobody updates it because nobody's ever asked to look at it again. The bank isn't going to call and remind you. It isn't part of their process, and it isn't their job. It's yours, and checking it takes about 5 minutes. And one more thing almost nobody mentions. One form rarely covers everything. A checking account is its own contract. A savings account is a separate one. A CD often needs its own paperwork. Investment accounts and retirement accounts each carry their own beneficiary designations, sitting in entirely different systems. Banks think account by account. Families think in terms of my money as one pot. That mismatch is exactly where people get blindsided, believing they've handled everything because one account is protected while a second account at the very same institution has nothing on file at all. So this isn't really a video about panic. It's about precision. A sole owner account with no beneficiary can absolutely get stuck in a slow, difficult process for the people left behind. A properly designated account can move in days. The difference isn't luck, and it isn't even money. It's one form, on file, up to date, at every institution where you hold an account. Here's the bottom line. One of the cruelest surprises a family can face isn't that the money wasn't there. It's that the money was there the entire time, and nobody could touch it when it mattered most. In most cases, that entire situation is preventable, and it starts with a single question you can ask your bank this week, completely free. Is there a beneficiary on file for every account I have? And is it still the right name?